Hey folks, welcome back to Honey Money SG, and this time let's update my February portfolio for Syfe. Now we had a lot of crises happening in February, right? Just when I thought January was the worst month ever for my Syfe portfolio last month. This time the tensions escalated between Russia and Ukraine because Russia just ordered its military troops for military operations in Ukraine after taking down two of their most easternmost cities. And now it's even going to attack the capital. So we definitely have an ongoing military conflict right now in this world. And the world is in such chaos right now, right? And even the US is imposing more trade sanctions against Russia to really cripple their finances. So many bad news happening this month, and my portfolio just took a nosedive, especially for Syfe. But you know what's the good news over here? The US Fed may be keeping to their 0.25% interest rate hike in March. And that's because of the war tensions, right? It have caused so much uncertainty and so much inflation in the global economy that if the Fed raises it straight away to 0.5%, I think there will be more dire consequences that we cannot imagine. So I think out of all the bad news, I think this is one of the good news that can at least keep us at calm. So let's just recap what my portfolio did for January 2021, right? So for my Syfe Wealth, I have three portfolios, right? Namely my Syfe Select Custom, which is named Diamond Hands. I do have a Syfe Equity 100 and a Syfe REIT Plus. So let's just take a look at Syfe Select Custom first. My Diamond Hands portfolio in January, it was losing around $161, which is more than 5% loss. And then for Equity 100, it registered like $29 of loss in January, which means a 2.9% drop. And lastly, for the worst performer, Syfe REIT Plus, it was performing at negative $74, which means a 7.4% loss. So coming up in this video, I will show you what are my current returns for my Syfe portfolio, especially in this turbulent month of February 2022. Let's go. Alright folks, so let's start off with the Syfe Wealth portfolio, and starting with my Diamond Hands portfolio, which is my Syfe Select Custom portfolio. For reference, the date today is the 26th of February 2022. So let's move to the details. And you can see that my invested amount is around 3.3k Singapore dollars. The current market value of my portfolio now is 3.1k. That represents like a $176 of loss. So if you take $176 divide by 3.3 thousand Singapore dollars, that would be like a negative 5% loss. Okay, 5.3% to be exact. So we have not been doing well for this Syfe Select Custom, even though I started last year in October, right? Okay, last year has been good. It has been trending up all the way until December. Okay, mid of December we suddenly like start going down already. We do have like some mini dips here and there, but we still ended the year positively. What happened after 2022? Okay, then when we started going down, man, we have so much fear, uncertainty, and doubt, right? The Fed has been announcing like the worst ever reports, telling us that they will keep increasing interest rates to curb inflation in January, right? Remember all those inflation fears and scaring the markets away. And then in February, we have all this Russian and Ukraine conflict that is going to scare investors even more and selling away their positions. And that is why your positions in Syfe and maybe in your stock portfolio are falling as well. In fact, we saw quite significant dips, especially if you are invested into growth stocks, which I will not talk about here. And you see that all this is really just trending down, right? My market value, even though I keep putting in money, it just keeps trending downwards. And it's just like a dippity dip trend. You buy the dip, it keeps dipping. You buy the dip more, it will come in the dippity dip of the dip. And it's just not good, right, in your emotions. But that's just the way it is, right? You can never really control the market because timing the market is really difficult. You could at one point sell away at the lows and then buying back at the high price, which is not what everybody wants. But that's just the way it is. And let's take a look at the composition, right, for my Diamond Hands portfolio. I do have three tickers here: QQQ, CSPX, and VWRA. Okay, let's take a look at some of the details here. So QQQ will invest in the 100 of the largest non-financial companies, which are your Microsoft, Apple, Facebook, and Google. So mainly the tech stocks of the US Nasdaq market. And then S&P 500, I'm sure many of you know, is just the US 500 biggest companies and consists of firms such as Microsoft, Apple, Amazon, Facebook, Berkshire Hathaway. And that's around 33% as well. Whereas for VWRA, this is an all-world UCITS ETF. So it tracks like the all-world index. So basically everywhere that has a stock market and those companies, the international companies that are listed, then VWRA will go and track them. okay, and include them under the VWRA basket ETF. So that's like a 32% as well. So all these three tickers, these ETFs, add up to around 99% of the portfolio. The remaining 1% is in cash to actually pay the management fees to Syfe. Okay, the management fees for Syfe is actually calculated to be 0.65%. So for every month, the end of the month, they will deduct a small amount of cash from your portfolio to actually pay the management fees. So all in all, Syfe Select Custom, my Diamond Hands portfolio, not doing well. In fact, it registered like a 5.3% loss from inception, right? So that's not a good result, and I think that's the same for everyone who has been invested in these ETFs. Okay, let's take a look at the next one, which is Honey Money Equity 100. So this is the Syfe Equity 100 portfolio. You must have known that I have reduced my position to $1,000 last year invested, so that represents a $31 loss, right? Current market value being $969, and that's a 3.1% loss. Not as bad as my Syfe Select Custom, and maybe the reason is because of the composition. So let's take a look at the composition, and you can see that there is much more ETF tickers right here in this portfolio of the Equity 100. I think more than 10 ETFs listed here in the Equity 100, right? The largest being QQQ, S&P 500 Equal Weight, S&P 500. Okay, we do have other emerging market ETFs and other sector ETFs like China, consumer staples, healthcare, clean shares, utilities, tech, and all that stuff. That means your risk is really diversified, but also means your returns are diversified as well, and it's more unlikely that you will 10x this portfolio over the long term because it's just a super diversified ETF, but it's stable, come to think of it, compared to my Syfe Select Custom of 3 ETFs. So we do have like 1% allocated for cash. That's for the management fees as well. So you will see that in this deduction over here at the end of every month. Okay, lastly is the REIT Plus portfolio, and that's what many of you sign up Syfe for, right, to get into their diversified REITs portfolio. And this is the 25th of February, last updated, and we can see the current market value is $953, which also means because I rebalanced it to $1,000 last year, that means I have experienced a loss of $47, and that is 4.7% loss. Still not too bad compared to my Syfe Select. I think month on month my REIT Plus is the only portfolio that actually increased in value, and that's maybe because with rumors that the Fed would not increase the interest rate to 0.5% in March, maybe maintaining it at 0.25%, that would be a really good news for REITs, because ultimately what REIT does is that they need to borrow money to finance their properties and go and lease it out, right? So increase in interest rate is not a good news for REITs, but decrease in interest rate will be tremendously good news for REITs, or rather a controlled increase in interest rates for that matter. So REITs are really affected by interest rates and all the movements that the Fed is going to do, but let's take a look at the composition first. Okay, I do have like a 99% invested for REITs. Likewise, I have a 1% cash allocation to pay the management fees. These are all automatic, you don't have to do anything. But the composition is only in the large few sponsors like your Capital Land REITs, your Ascenders REITs, your Maple Trees, your Frasers, and all that stuff, right? These are the more strong sponsors and slightly more defensive compared to those high risk, high return REITs like your hospitality and commercial malls, because these are the main companies that has been in Singapore for many years, and they do have a strong financial fundamentals, so they are not likely to run away with your money, because they have really strong properties with good cash flow over the years. And you can see that my top few holdings are already more than 50%. Okay, those are the top few holdings in the Frasers, Maples, and the Ascenders. Now for REITs, we are looking more into cash flow play, right? Because REITs do pay out a good amount of dividends. And where do all these dividends go to? You can actually select them. For me, my REITs are actually reinvested via this dividend option, right? You can select either reinvest or payout, but I would prefer a reinvest because you don't really need the cash flow at this age. Maybe in your later age at 50 to 60 years old, then you will prefer a payout option, especially when you are no longer working, right? You are retired, so you need a bit of that cash flow. So that's where REITs will be a really good income and cash flow play for you. Now you do have to remember that for my REIT Plus portfolio, I have to do like manual transactions to withdraw cash, because all the referrals will be paid via my REIT Plus account, and Syfe doesn't segregate them for you, so you have to do like a manual withdrawal, otherwise it will just be auto reinvested into the REIT Plus portfolio. Alright, so this is it. My 3 portfolios have not been doing well on a month-on-one period other than my REIT Plus, surprisingly. But that's just how the way it is. Keep invested, do dollar cost average, because as long as you believe the market will go up in the long term, this is just a slight dip, and even the tensions would end one day, and then we can all go back to the uptrend that we have been looking forward to. So with that, let's get back to the video. Alright, so you have seen my Syfe REIT portfolio, but I do have another Syfe trade portfolio, as all of you may know. So I do a dollar cost average to Google quite regularly, like weekly, put in $100, and let's see how far has this Google trade come to. Alright folks, so here is my Syfe trade mobile platform, right? And you can see there are no web platforms, so I can only use my mobile apps to go and show you guys how this works, right? So for those who have seen my Syfe trade video, you'll know that you get 5 free trades every month. So it's really a good way to actually play some trades if you really don't like to pay commission fees, but it's only limited to US stocks and not available for Singapore stocks, Hong Kong stocks, all those stuff. And here's my watch list, you can take a look. But what I want to show you here is how much have I performed, right? And I only bought one stock, which is Google, Alphabet. Right now, the unrealized loss is around $20, $21. I've been dollar cost averaging throughout the market, but because almost all US stocks have been on a relative downtrend for this past few weeks, that's why we see the stock performing really weak, right? It has been on a regular downtrend, and I've been incurring a loss even though Google announced that they will be performing a stock split. So here are some of my few transactions. I'll do a dollar cost average of $100 every week to just buy into the market, right? So you can see that as Google price drops, you can actually buy more units with the same value of $100, and that's why dollar cost averaging may be the best strategy to take emotions out of your investing strategy. When the price goes up, you buy. When the price goes down, you cry a little bit and you buy more. This is a line that I learned from my senpai. Yeah? So really, it has been on the unrealized profit or loss, but it's just paper, and $20 is not a lot. Anyway, I only invested around $780. Right now, my market value, if including my referrals of $150, is around $881. So if you want to look at the details of what Google stock has, you can click on this, and then you can see all the chart stuff, right? The 1-day chart, 1-week chart, 1-month chart, 3 months chart, okay? Very good stuff on the mobile app, especially when now more people use to trade on their mobile phones because it's more convenient rather than sitting down on the laptop. So you could see some really useful information here, like the EPS, revenue, EBITDA, all this stuff, right? And Google is a fundamentally really good stock. That's why everything is green. But just that the price is not performing very well these few weeks because of all the tensions that I mentioned. And you could even see like analyst ratings, right? All 41 ratings recommending you to buy instead of sell, right? That's a very strong fundamental stock. And the reason why I chose Google is because Google share price is so expensive at 2,000 over, right? So Syfe actually allows you to do fractional trading. That means that you can buy like 0.01 shares, and that's a really more affordable price for people to do dollar cost average than to buy 1 unit of Google share every week or every month, right? 2,000 over dollars. That's a huge amount to actually deploy. So that's really the benefit of Syfe Trade, right? Offering you like fractional shares trading, as well as giving you some free trades per month. Now after the promotion, you will only be limited to 2 free trades per month, so maybe you want to adjust your dollar cost strategy a bit differently. But overall, my Google stock has not been performing well for this past few weeks as well, but in the long term, I do believe that Google will be a long-term winner. So I'll continue to dollar cost average into Google, and that's my investing strategy for Syfe Trade. So you have seen both my portfolios. Obviously, they have not done very well for February, and I'm sure many of us who are holding on to Syfe portfolios are feeling the same way as well. But what we could see is at least we have some certainty of the war, that some stock tickers are actually going back up after the certainty. So I feel that there's a little bit of relief for some of us here. Can see some green in the markets, right? But anyway, if you haven't signed up for Syfe yet, remember to use my promo code called HoneyMoney. Key in the promo box below so that you can get some fees off your management fees for Syfe. And if you're curious about my Jan performance, right, then refer to this video over here where I did a previous update in January. With that, thank you for watching. My name is Christopher. This is HoneyMoney SG, steering young adults to financial independence.